Hello all. Now in the booster series of lectures, let us start with the third chapter, income from house property. First, section 22 to 27, these are the sections that are covered under the head income from house property. What is the charging section? Charging section is section 22. What is the method of accounting followed under the head income from house property? Method of accounting is accrual basis, except municipal taxes. That means income under the head house property and expenditure is allowed as deduction on accrual basis except municipal taxes. Municipal taxes are allowed as deduction on cash basis. What do you mean by accrual basis? Let's say house property is given on rent for 12 months. Out of 12 months, 8 months rent was paid. 4 months rent was unpaid. Whatever the 4 months rent unpaid is there, even that also to be considered in calculation of income from house property, because not only received, whatever the amount that is receivable is there, even that will also be considered in calculation of income from house property, because method of accounting followed is accrual basis. Next, if any advance rent is received, advance rent will not be considered because advance received is a form of deposit. It is a liability which is to be given at the end of the tenancy. So that is why whatever the advance rent that is received is there, that will not be considered as income. Next. Tax rates. Tax rates applicable under the head house property are normal tax rates. That means either default tax rates or optional tax rates. Special tax rates are not applicable under the head house property. What is the charging section? Charging section is section 22, right? So as per charging section 22, there are three conditions. If all these three conditions are satisfied, then only income is taxable under the head house property. First condition is asset must be a house property. Second condition is SSE should be the owner of the house property. This is second condition. Third condition is SSE shall not use house property for his own business or profession. If these three conditions are satisfied, what is the conjunction between conditions? Conjunction is and. If all these three conditions are satisfied, then only income is taxable under the head house property. Asset must be house property. SSE should be the owner of the house property. SSE shall not use the house property for his own business or profession. Now, let us interpret it further. Sir, what do you mean by house property? House property means building plus land attached to the building. Sir, what do you mean by this? Let's say there is a building and there is a compound wall. Within the compound wall, whatever the land is there, even that land is also considered as house property. Let's say car garage is there, that is also considered as house property. Garden is there, that is also considered as house property. Swimming pool is there, that is also considered as house property. Cattle shed is there, that is also considered as house property. Playground is there, that is also considered as house property. So whatever the land that is attached to the building within the compound wall is there, that is considered as house property. That means by giving car shed on rent, if any rental income is received, even that rental income is also taxable under the head house property. If you go to apartments, there will be cellar. Okay, by giving cellar on rent, if any rental income is received, even that rental income is also taxable under the head house property. Let's say my car, I took car space in apartment and I'm keeping my car in the apartment by paying 2000 rupees as rent. Whatever the rental income received 2000 is there, that is also considered as uh, income from house property. Next. Building include not only residential building. What do you mean by this? Not only residential building. Like even if commercial buildings are given on rent, whatever the rental income that is received is there, that is taxable under the head income from house property. I have a building. I gave that building on a rent to a office. That means tenant is using that building for commercial purpose. Still, for me, whatever the rental income that is received is that is taxable under the head house property. That means what? The purpose for which tenant is using the building, that is not at all relevant. Okay, whether the building is used by tenant for residential purpose or commercial purpose, that is not at all relevant. Whatever the rental income that is received from house property is there, it is taxable under the head income from house property. Next, see, there is a vacant land here. By giving vacant land on rent, you have received rental income. Now this rental income is not taxable under the head house property. It is not taxable under the head house property. It is taxable either under the head PGBP or IFOS. Sir, why sir? Because vacant land is not a house property. That's why by giving vacant land on rent, if any rental income is received, that is taxable either under PGBP or IFOS. Second condition is SSE should be the owner of the house property. Ownership includes legal ownership as well as deemed ownership. Legal ownership means what? Like title, he is holding the title. Property is registered in his own name. Okay, then we can say SSE is having legal ownership. Deemed ownership means what? Sometimes SSE is not the owner of the house property. Even though he is not the owner of the house property, still rental income received by another person will also be taxed in the hands of the SSE. That we call as deemed ownership. Regarding deemed ownership, let us discuss in detail little after. Next, SSE need not be the owner of the land upon which building is constructed. What do you mean by this? See, even though SSE is not the owner of the land, but if SSE is the owner of the building, sufficient. Whatever the rental income received from building is there, such rental income is taxable under the head income from house property. I took land on lease for 99 years. I constructed one building. I gave that building on rent, earning rental income. That rental income is taxable to me under the head house property. I am the owner of the building, but I am not the owner of the land. Still, rental income is taxable under the head house property. Next. See, in previous year, I am the owner. On 31st March of the previous year, I sold the house property. That means in assessment year, I am not the owner. You all know income of previous year is taxable in the assessment year. So in the year of taxability assessment year, I am not the owner of the house property. Even though I am not the owner of the house property in assessment year, still rental income is taxable to me under the head house property because I am the owner during the previous year. That means what? Ownership during previous year is sufficient. SSE need not be the owner during assessment year. Sometimes house property will be under dispute. Brother 1, brother 2 are there. They are fighting for one house property. So whenever property is under dispute in a court, okay, then income tax department will decide in whose hands that rental income will be taxable. Generally, income tax department will consider such brother who is enjoying the property. Let's say brother 1 is showing domination over brother 2 and brother 1 is taking all the rental income. In this case, income tax department will consider brother 1 as the owner and income tax department will tax it in the hands of brother 1. Next, income from subletting is taxable. Obviously, sir, why income from subletting is not taxable? What is second condition? SSE should be the owner of the house property. What do you mean by this? Let's say X, Y, Z are there. X is owner of house property. Now, X gave this house property on rent to Y for 3 years. Rent is 10,000 per month. Now, Y gave this house property on subletting basis to Z for 1 year. Rent is 13,000 per month. Now, from Z, every month 13,000 will be received by Y, right? This 13,000 is taxable either under PGBP or IFOS. Sir, why sir? The reason is Y is not the owner of the house property. As Y is not the owner of the house property, whatever the rental income that is received is there, that is either taxable under PGBP or IFOS. Next, whatever 10,000 received by owner is there, that is taxable under the head income from house property. Are you able to understand? SSE shall not use the house property for his own business or profession. Let's say I am a chartered accountant in practice. I have a own house. In first floor, I am living along with my family. Ground floor I am using for my professional practice. That means what? Ground floor I am using for my self occupation, and I am using that ground floor for my own business or profession. Now ground floor is not taxable under the head house property, it is taxable under the head PGBP. Whatever the income is there, that is taxable under PGBP. Whatever the ground floor related expenses are there, municipal taxes, repairs, everything, those are also allowed as deduction under PGBP. That means for an income to be taxable under the head house property, as per charging section, there are three conditions. If all these three conditions are satisfied, income is taxable under the head house property. Asset must be a house property. Assessor should be the owner of the house property. Assessor shall not use the house property for his own business or profession. Now let us discuss deemed ownership. First, transfer of house property by an individual to his or her spouse. You know spouse, right? For husband, spouse is wife. For wife, spouse is husband. Otherwise than for adequate consideration. What do you mean by this? Mr. A is there. Mr. A has one house property. This house property Mr. A transferred to Mrs. A, and the transfer happened either for without consideration or for inadequate consideration. What do you mean by this? House property value is 1 crore. Okay, Mr. A gave house property to Mrs. A for free of cost for 0 rupees, or Mr. A transferred house property to Mrs. A for 40 lakhs. 40 lakhs Mrs. A gave, that means 60 lakhs Mrs. A did not give. In this case, whether Mrs. A is giving total consideration? No. In this case, property is transferred only for 40 lakhs. How much is inadequate consideration? 60 lakhs is inadequate consideration. So whenever house property is transferred for either without consideration or for inadequate consideration, in this case generally rental income will be received from house property, right? Who will receive rental income? Mrs. A will receive rental income. Even though Mrs. A receives the rental income, Mr. A will be considered as deemed owner of the house property, and whatever the rental income that is received by Mrs. A is there, that is taxable in the hands of Mr. A. That means gift to spouse. Whenever house property is given as gift to spouse, even though rental income is received by spouse, such rental income is not taxable in the hands of spouse, because the transferor will be considered as deemed owner, and entire rental income will be taxed in the hands of transferor being deemed owner. There are exceptions. When house property is transferred for adequate consideration, Mr. A gave house property to Mrs. A, Mrs. A paid 1 crore rupees to Mr. A. In this case, just like how third party pays consideration, even spouse also paid 1 crore rupees consideration. In this case, deemed ownership concept is not applicable. Transferred to spouse through an agreement to live apart. That means what? Divorce. At the time of divorce, as per the orders of the court, if any property is transferred to spouse, then deemed ownership concept is not applicable. Then whatever the rental income is there, that is taxable in the hands of spouse only. Next, transfer of house property by an individual to his or her minor children for without consideration or for inadequate consideration. You know Sachin Tendulkar, right? Sachin Tendulkar, for his son's birthday, he gifted a house property. He gifted a bungalow. Now, how he transferred house property? He can transfer house property either for without consideration or for inadequate consideration. In this case, from house property, rental income will be there, right? Who will receive rental income? Rental income will be received by Arjun Tendulkar. Let's say Arjun Tendulkar is minor. His age is 15 years. Now rental income is received by Arjun Tendulkar. Even though rental income is received by Arjun Tendulkar, this rental income will be taxable in the hands of Sachin Tendulkar. Sir, why sir? Because if any house property is transferred to minor child, either for without consideration or for inadequate consideration, we call it as gift. In such a case, whoever the transferor is there, here transferor is Sachin Tendulkar, father, they will be considered as deemed owner of the house property. Are you able to understand? But there is one exception. Let's say The property value is 2 crores. Sachin Tendulkar transferred house property in the name of Arjun Tendulkar, and Arjun Tendulkar paid 2 crore rupees consideration. In this case, house property is transferred for adequate consideration. So deemed ownership concept is not applicable. Simple, deemed ownership concept is applicable only if house property is transferred for without consideration or for inadequate consideration. If property is transferred for adequate consideration, then deemed ownership concept is not applicable. Another point is also there. If house property is transferred to minor married daughter, then also deemed ownership concept is not applicable. You can see exceptions. If transfer is made for adequate consideration, minor excludes minor married daughter. That means what? If house property is transferred to minor married daughter, deemed ownership concept is not applicable. It is taxable in the hands of minor married daughter only. See this point, where cash is transferred to spouse or minor child and transferee acquires property out of such cash, then transferor shall not be treated as deemed owner. What do you mean by this? Let's say husband is there. Husband gave cash to wife or minor child. Now using this cash, wife or minor child, they purchased house property. For this house property, husband will not be considered as a deemed owner. Section 27 is not applicable. Here, even though section 27 is not applicable, clubbing provisions will get applicable. Are you able to understand? So whenever directly house property is transferred, then only deemed ownership concept is applicable. If cash is given to wife or minor children, and through that cash if they purchase house property, then section 27 deemed ownership concept is not applicable. Then clubbing provisions under section 64 are applicable. Anyhow, it is taxable in the hands of transferor only, whether it is deemed ownership or clubbing provisions. Next. Allotment or lease of house property by a cooperative society, company or AOP to its members under house building scheme. What do you mean by this? Let's say there are 10 members. All of them came together and they formed cooperative society. Now this society went to HDFC Bank. They borrowed 10 crores loan. Using this 10 crore loan, they constructed a building consisting of 10 flats. Now, who is the owner of this entire apartments? The owner is cooperative society. After construction, what cooperative society has done? Cooperative society allotted each flat to one member. There are 10 members, right? For 10 members, 10 flats were allotted and each member is using his flat. Observe very carefully. Here, namesake on the document, cooperative society is the owner. But who is using the apartments? Each member of the cooperative society is using the apartments. That means, in this case, the benefit is received by individual members, but the property is registered in the name of the cooperative society. In this case, let's say first member, he gave this his flat on rent and he is receiving rental income. Who is receiving rental income? First member is receiving the rental income, but property is registered in whose name? Cooperative society name. So here there is gap. So that's why even the property is in the name of the cooperative society, whoever the person to whom house property is allotted, he will be considered as deemed owner. Now in this case, even the house property is in the name of the cooperative society, whoever the member of the flat to whom house property is allotted, to whom apartment allotted is there, that person will be considered as deemed owner, and whatever the rental income that is received is there, it is taxable in the hands of allotted member and not in the hands of cooperative society. So who will be considered as deemed owner? A member to whom building allotted is treated as deemed owner of the house property. Next, holder of an impartiable estate. Sir, what do you mean by impartiable estate? Let's say Ambani is there, Mukesh Ambani. How many children he has? He has 3 children, right? Akash, Anant and Isha. Am I correct? Yes. Now, one fine day, Ambani distributed all his assets to all the three children. Whatever the assets he is having, he equally distributed all the assets to Akash Ambani, Anant Ambani as well as Isha Ambani. Now, there is a temple. This temple is sentimental. Ambani don't want to sell this temple, or Ambani don't want to demolish this temple. So Ambani wrote in the deed, this temple belongs to all the three children and this temple cannot be divided among the three children. Okay, impartial estate means what? Asset which cannot be divided. Here temple cannot be divided among the three children. That means what? On this temple, Akash Ambani, Anant Ambani, Isha Ambani, all the three are having the rights. But what Mukesh Ambani did, Mukesh Ambani appointed elder son, okay, Akash Ambani as trustee of the temple. See, temple is there, someone has to overlook the temple, right? So for overlooking the temple, Akash Ambani was appointed as the trustee. So Akash Ambani will take care of the temple. He will give temple premises on rent to shops. He will give, temples Kalyana Mandapam on rent, and he will oversee the activities of temple. In this case, even though the property is not divisible among the three children, till whoever the trustee is there, trustee will be considered as deemed owner of the temple. And whatever the rental income from temple is there, even though all the three children are having legal rights, still rental income from such temple is taxable in the hands of trustee only. I have answer for this logic. See, based on performance of Akash Ambani, temple will run. If Akash Ambani takes care of temple, temple will generate more revenue. If Akash Ambani ignores, temple will not generate any revenue. That means revenue of temple is depending upon the overseeing of operations by Akash Ambani. So that's why whoever the trustee is there for impartial estate, he will be considered as deemed owner. Whatever the efforts that he keeps, based on that he is going to rental income. Even though rental income is shared by all the members, still as per the provisions of Income Tax Act, entire rental income is taxable in the hands of trustee only, because he will be considered as deemed owner. So holder or trustee will be treated as deemed owner of the house property. Next, transfer of immovable property under part performance of a contract. What do you mean by this? Let's say there is one building. This building is owned by Revant. Now I wanted to purchase that building. I went to Revant's house and I asked him, I wanted to purchase this building today itself. Revant said 2 crore rupees is the consideration. I said I am ready to pay 2 crore rupees consideration. Now I paid 2 crore rupees consideration to Revant. Next, I did agreement. Sale agreement I have written with the Revant. From tomorrow onwards, I occupied the building. Whatever the building is there, this building is occupied by me. But I told Revant, currently stamp duty charges are very high in our area. Let us register this property in my name after 6 months. I told this to Revant. That means what? Physically registration does not happen. In case of immovable property, property is said to be transferred only if registration is done. But in this case, property is not registered in my name, but I have paid the consideration, I have written the sale agreement, and I started occupying the property. The moment these three conditions are satisfied, buyer has paid the consideration or buyer is ready to pay the consideration, there was agreement between seller and buyer has taken possession of the property. Possession means what? Buyer started occupying the property and controlling the property. If these three conditions are satisfied, even though house property is not registered in the name of buyer, still buyer will be considered as deemed owner of the house property, and whatever the rental income is there, that is taxable in the hands of buyer only. Are you able to understand? So you can see 3 points. Agreement in writing between buyer and seller. Writing, that means if there is oral agreement, this provision is not applicable. Only if there is written agreement between buyer and seller and buyer has paid the consideration or is ready to pay the consideration, buyer has taken possession of the property. If all these three conditions are satisfied, then buyer will be considered as deemed owner, and whatever the rental income is there, even though property is not registered in the name of buyer, still buyer will be considered as deemed owner and entire rental income is taxable in the hands of buyer. Next, sixth, a person who acquires right in a building by way of lease for a period 12 years or more. What do you mean by this? If lessee takes a building on lease for 12 years or more, then lessee will also be considered as deemed owner, and lessee by way of sublease, if he gets any rental income, that is also taxable to the lessee under the head income from house property. Let us see one example. There is X, Y, Z. X gave his house property on lease for 15 years to Y. Lease amount is 20,000 per month. Y gave the house property on sublease to Z for 2 years. Lease amount is 25,000 per month. Now, Z will pay 25,000 per month to Y, right? This 25,000 is taxable to Y under the head income from house property. Sir, why, sir? Because Y is considered as deemed owner. Y has taken property, house property on lease for 12 years or more. So Y is considered as deemed owner. The moment he is considered as deemed owner, whatever the rental income that is received, it is taxable to Y also under the head income from house property. See, Y is not the owner, but he has taken on lease for 12 years or more. Now he will be considered as deemed owner. As he is deemed owner, whatever the rental income that is received, it is taxable under the head income from house property to Y. And Y will pay 20,000 rupees to X, right? Obviously that 20,000 is taxable to X under the head income from house property, because X is the owner of the house property. For example, in this case, lease period is not 5 years, but lease period is not 15 years, but lease period is 5 years. In this case, for Y, the income is not taxable under the head house property, it is taxable either under the head PGBP or IFOS. Did you understand the difference? If period of lease is less than 12 years, then deemed ownership concept is not applicable and lessee will not be considered as deemed owner. If period of lease is greater than or equal to 12 years, lessee will be considered as deemed owner, and entire rental income, even in the hands of lessee also, it is taxable under the head income from house property. Now let us discuss usage of house property. You are having a house property. Now how can you use that house property? In how many ways? Either house property can be self-occupied. Self-occupied means what? Used by the SSC. Or house property can be let out. You will give that house property and rent it to the tenant. Third, it will be unoccupied. That means that will not be used by anyone and it is idle. So house property can be either self-occupied or let out or unoccupied. If house property is used for residential purpose, that means you and your family are living in that house property. In that case, that house property is taxable under the head income from house property only, and it is treated as self-occupied property. I am owning one house, but I am not using that house for my family purpose, residential purpose. I am using that house for my professional practice. That means what? Here I am using that house for business or profession purpose. In this case, it is taxable to me under the head PGBP. So self-occupied property used for residential purposes, taxable under the head house property. Self-occupied property used for business or profession, taxable under the head PGBP. House property is let out. See, once you rent a house property, how the tenant uses that property is not relevant. Whether tenant uses that property for residential purpose or commercial purpose, still rental income received is taxable under the head income from house property. I have one flat. I gave that flat on rent. Tenant is using that for residential purpose, taxable under house property. Tenant is using that flat as a office, still it is taxable under the head house property. Are you able to understand? Next, let out incidental to business. What do you mean by incidental to business? I constructed 4 floors building. How many floors building? 4 floors building. Here my business is there. Through this business, I am doing 100 crores turnover. The moment you do 100 crores turnover, immediately everybody's eyes will be on you. So I want to protect my business. What I did, first floor I gave on rent to income tax department. Second floor I gave on rent to GST department. Third floor I gave on rent to enforcement directorate. Intentionally I can give my other floors on rent to other persons also, but I did not give. I gave remaining floors of my building as a rent only to government departments, so that tomorrow if something comes, some notice comes on me, through taking these help I can minimize the penalty. That means the idea behind giving my house on rent to these departments is for my business purpose. So whenever house property is let out incidental to business, normally if a flat is given on rent, whatever the rental income that I receives, it is taxable to me under the head house property. But in this case, from these three departments, whatever the rental income that is received by me is there, that is taxable to me under the head PGBP, because I have given house property on rent for my business purpose. So whenever house property is given on rent incidental to business, then whatever the rental income that is received, it is taxable under the head PGBP. Are you able to understand? Next, let out by SSE engaged in the business of letting out of properties. What do you mean by letting out of properties? My main business is buying house properties, giving them on rent and earning rental income. That means SSC's main business is purchasing properties and giving them on rent and earning rental income. So main business of SSC is earning rental income from properties. Now whatever the rental income that is received, it is not taxable under the head house property, it is taxable under the head PGBP. Next, let us see format for computing income from house property. See, there are 4 types of properties: self-occupied property, unoccupied property, let out property, deemed to be let out property. For self-occupied property and unoccupied property, there is one format. For let out property and deemed to be let out property, there is one format. So this is the format. First you will calculate gross annual value. From that you will reduce municipal taxes. Thereby you will arrive at net annual value. From net annual value, 2 deductions are allowed. Deduction under section 24A standard deduction, 24B interest on borrowed capital. Thereby you will arrive at income from house property. First, in case of self-occupied property or unoccupied property, gross annual value will be considered as 0. Municipal taxes are also not allowed as deduction. Thereby net annual value is also 0. Standard deduction 24A is also not allowed. Only interest on borrowed capital is allowed as deduction. So that is why for self-occupied property, income is always 0. If there is interest on borrowed capital, then there will be no income, there will be loss from self-occupied property. So for self-occupied property, there is no income. Income is always 0. Only if there is interest on borrowed capital, then for self-occupied property, there will be loss from self-occupied property. Are you able to understand? Next, for let out property and deemed to be let out property, let us see. Now, first let us discuss about gross annual value calculation, how GAV will be calculated. See, these are the steps for computing gross annual value. First, step 1 is fair rent or municipal rent, whichever is higher. First of all, what do you mean by gross annual value, sir? I already told you, under that house property, not on rental income tax is levied. Tax is levied on annual value of the house property. What do you mean by annual value? Annual value is the inherent capacity of the house property. Whatever the amount of rent that house property can fetch, that we call as annual value. So under that house property, actual rental income is not taxable, but annual value is taxable. These are the steps in computing annual value. Step 1, Fair rent or municipal rent, whichever is higher. Fair rent means what? Rent of similar property in the same locality. If the same, like I'm living in 3 BHK flat. If in my locality, if the same such kind of 3 BHK flat is there, whatever the rent that is fetched by the same 3 BHK flat is there, that rent we call as fair rent. Municipal rent means what? Whatever the rent that is fixed by municipal authorities for collecting municipal taxes. The type of rent we call as municipal rent. So fair rent or municipal rent, whichever is higher. That is step 1. Step 2. Result of step 1 or standard rent, whichever is lower. So, result of step 1 or standard rent, whichever is lower. Sir, what do you mean by standard rent? Standard rent is the rent as per Rent Control Act. There is Rent Control Act. Rent Control Act will prescribe what is the maximum rent that can be charged for that house property. That maximum rent we call as standard rent. So step 2 is result of step 1 or standard rent, whichever is lower. Result of step 2 is also called as expected rent. So step 1, fair rent or municipal rent, whichever is higher. Step 2, result of step 1 or standard rent, whichever is lower. So step 2 is also called as expected rent. In step 3, we will compare actual rent minus unrealized rent with expected rent. Here, listen carefully. What do you mean by unrealized rent? Whatever the rent that could not be realized from tenant is there, that rent we call as unrealized rent. I gave my flat on rent to a tenant. Tenant occupied my flat for 12 months. For 7 months he paid the rent. For balance 5 months he is not paying the rent. When I went to my flat to ask him for 5 months of rent, he is shouting at me and he came to beat me, but somehow I escaped. So 5 months rent he did not pay me. I could not get from him. That rent could not be realized. Whatever the rent that could not be realized from tenant is there, that we call as unrealized rent. What is method of accounting? Accrual basis. As per accrual basis, I got a right to receive rent from my tenant for 12 months because he occupied my house for 12 months. I am entitled to receive 12 months rent. So as per rules of house property, method of accounting accrual basis, 12 months rent is taxable to me. But did I get 12 months rent? No, I got only 7 months rent. Balance 5 months rent my tenant is not giving to me. I could not realize from him. This 5 months rent we can call as unrealized rent. So in step 3, whatever the unrealized rent is there, that can be reduced. But this unrealized can be reduced, rent can be reduced subject to satisfaction of 4 conditions. You can see. If all these 4 conditions are satisfied, what is the conjunction? And. Then only unrealized rent can be reduced from actual rent. First of all, tenancy is bona fide. Agreement between owner, that means me and the tenant, is genuine. So only if agreement between owner and tenant is genuine, then only unrealized rent can be reduced from actual rent. Second condition, defaulting tenant has vacated or steps for the same are taken. What do you mean by this? My tenant is not giving me rent. First, I should ask him to pay balance my 5 months rent. He is shouting at me and is coming to beat me. Now I should go to the police station and give complaint on him that he is not giving my 5 months rent. So tenant should vacate my house property. If he is not paying me rent, he should vacate the house property, or I should give police complaint to make him vacate the house property. That is condition 2. Third condition, he is not in occupation of assessee's any other property. That means he should not occupy house property, another house property of the owner. What do you mean by this? I have 3 flats. Now in one flat he resided, 7 months rent he paid, 5 months rent unpaid. I asked him to vacate the property and I asked him to come and join in my second flat. That means what? There is some agreement in between us. If he comes and joins in my second flat, then unrealized rent is not reduced from actual rent. Unrealized rent will be reduced only if defaulting tenant do not occupy another house property of the owner. Then only unrealized rent will be reduced from actual rent. So that is third condition. Defaulting tenant shall not occupy another house property of the same owner. Fourth condition, SSC has taken steps for recovery of unpaid rent. Whatever 5 months unpaid rent is there, he vacated the house property. Now I have to go and file another complaint to the police. He did not give 5 months rent to me, and I have to make effort to realize that 5 months rent also. That is fourth condition. Like owner has taken steps for recovery of unpaid rent. If all these four conditions are satisfied, then unrealized rent can be reduced from actual rent. Let us see. First, agreement between owner and tenant must be genuine. Tenant has vacated the property or steps for vacating the tenant are taken. Next, third condition, tenant is not occupying another house property of the same owner. Fourth condition, owner has taken steps for recovery of unpaid rent. If all these four conditions are satisfied, then unrealized rent can be reduced from actual rent. So in step 3, what we will do, we will compare actual rent minus unrealized rent with expected rent. Are you able to understand? So in second step, expected rent is there, right? We will compare actual rent minus unrealized rent with expected rent. See, from income tax department point of view, it is always interested in collecting more and more taxes. If actual rent minus unrealized rent is greater than expected rent, see, actual rent minus unrealized rent, that means rent collected by me is 1 lakh, expected rent is 70,000. Now income tax department will collect a tax on 1 lakh rupees because higher income, right? So if actual rent minus unrealized rent is greater than or equal to expected rent, then actual rent minus unrealized rent itself will be considered as gross annual value. So if they levy tax on 1 lakh rupees, they will get more tax. So whenever actual rent is greater than expected rent, actual rent will be considered as gross annual value. If actual rent minus unrealized rent is less than expected rent, then two cases are there. Then income tax department will check why actual rent is less than expected rent. If the reason for actual rent less than expected rent is a vacancy, then actual rent minus unrealized rent will only be considered as gross annual value. If the reason for actual rent less than expected rent is any reason other than vacancy, then expected rent will be considered as gross annual value. I gave house property on rent for 12 months. I received rent for 12 months. Rent is 6,000 per month. 6,000 into 12, 72,000. For 12 months occupied, 12 months rent, 72,000 I have received. But expected rent is 90,000. That means 72,000 is less than 90,000. Now, is it vacant? No, for 12 months it is occupied. So reason for actual rent less than expected rent is not vacancy. In this case, whatever expected rent 90,000 is there, that will be considered as gross annual value. Are you able to understand? Now, sir, how can we tell that house property actual rent is less than expected rent because of vacancy? Here there are conditions. If these three conditions are satisfied, then we can tell the reason for actual rent less than expected rent is because of vacancy. Out of these three conditions, if any one of the conditions are not satisfied, then we can tell actual rent less than expected rent is the reason for actual rent less than expected rent is reason other than vacancy. Okay. So you will understand these conditions only through an example. That's why I have given example for you. Let us solve this example so that you will get better clarity about how to calculate. When can we tell actual rent is less than expected rent and reason for it is vacancy? If these three conditions are satisfied. Condition 1, house property should be a let out property and that house property is vacated during the previous year. Because of vacancy, actual rent is less than expected rent. If vacancy was not there, that means if house property is occupied for 12 months, then actual rent is greater than or equal to expected rent. If these three conditions are satisfied, then we can tell reason for actual rent being less than expected rent is vacancy. Through this problem, let us understand how to calculate gross annual value. My dear students, this problem has enough number of permutations to understand concept of gross annual value. Please uh, listen to the entire problem so that you will get complete clarity. First, house 1. Let us calculate gross annual value. Step 1 is fair rent or municipal rent, whichever is higher. Whichever is higher means how much? 2 lakhs. So result of step 1 is 2 lakhs. How much is standard rent? Standard rent is 1.5 lakhs. Whichever is lower means 1.5 lakhs is expected rent. The expected rent is 1.5 lakhs. The house property is let out for 12 months. Actual rent is 20,000. That means what? Actual rent is equal to actual rent minus unrealized rent. 20,000 into 12 months minus 0. Am I correct or not? There is no unrealized rent. The actual rent minus unrealized rent is 2,40,000. Now let us compare actual rent minus unrealized rent with expected rent. Actual rent minus unrealized rent is 2,40,000. Expected rent is 1.5 lakhs. Here actual rent minus unrealized rent is greater than expected rent. So in this case gross annual value is equal to actual rent minus unrealized rent, which is equal to 2,40,000. Next, case 2. House property 2. Fair rent or municipal rent, whichever is higher means how much? 3 lakhs. So result of step 1, 3 lakhs. Standard rent 4 lakhs. So result of step 1 or standard rent, whichever is lower means expected rent is 3 lakhs. Actual rent. House property is let out for 30,000 rupees. It is let out for 5 months. See, in an year there are 12 months, right? Out of 12 months, 5 months it is let out, 7 months it is vacant. That means how many months rent is received? Only 5 months rent is received. So how much is actual rent? Actual rent is 30,000 into 5 minus how much is unrealized rent? Unrealized rent is nil. So 30,000 into 5, how much? 1,50,000. The actual rent minus unrealized rent is 1,50,000. Let us compare actual rent minus unrealized rent with expected rent. 1,50,000. How much is expected rent? Expected rent is 3 lakhs. Compare. Here actual rent minus unrealized rent is less than expected rent. Now we have to do vacancy test. There are 3 conditions. If these 3 conditions are satisfied, reason is vacancy. Out of these 3 conditions, any one of the conditions not satisfied, reason is other than vacancy. Condition 1, house property should be let out. Whether house property is let out? Yes, house property is let out. Condition 2, house property is let out for 5 months, right? So condition 1 satisfied. Second property, house property should be vacant. Whether house property is vacant? Yes, house property is vacant for 7 months. Third condition, no vacancy. If there is no vacancy, then let us compare. If there is no vacancy, actual rent is equal to 30,000 into 12, 3.6 lakhs. That means if there is no vacancy, actual rent minus unrealized rent is 3.6 lakhs. Expected rent is 3 lakhs. What is the equation now? Here actual rent minus unrealized rent is greater than expected rent. That means what? Condition 3 also satisfied. You can see. What condition 3? If there is no vacancy, actual rent minus unrealized rent should be greater than or equal to expected rent. Yes. Here actual rent minus unrealized rent is greater than expected rent. Condition 3 also satisfied. If all the 3 conditions are satisfied, reason for actual rent less than expected rent is vacancy. So if reason is vacancy, then gross annual value is equal to actual rent minus unrealized rent. Original actual rent minus unrealized rent. How much is original actual rent minus unrealized rent? 1.5 lakh. That will be considered as gross annual value. So for house property 2, gross annual value is equal to 1,50,000. Did you understand? Next, let us see for house property 3. fair rent or municipal rent, whichever is higher. So result of step 1, whichever is higher means 5,04,000. Step 2, result of step 1 or standard rent. Standard rent not given in the question. If standard rent is not given in the question, don't keep 0. 5,04,000 or 0, whichever is lower means 0. If expected rent is 0, then comedy, entire house property income will be 0. Don't do like that. If standard rent is not given in the question, result of step 1 is result of step 2. The result of step 2 is also 5,04,000. Result of step 2 we call as expected rent. So actual rent is 50,000. House property is let out for 6 months, vacant for 6 months. Now let us calculate actual rent minus unrealized rent. 50,000 into how many months it is let out? 6 months, right? So 50,000 into 6 months minus unrealized rent. How much is unrealized rent? 54,000. So 3 lakhs minus 54,000, how much? 3 lakh minus 54,000, 2,46,000. The actual rent minus unrealized rent is 2,46,000. Let us compare it with expected rent. How much is expected rent? Expected rent is 5,04,000. The actual rent minus unrealized rent is less than expected rent. So gross annual value. Now we have to check vacancy test. If vacancy test is qualified, then actual rent minus unrealized rent is gross annual value. If vacancy test is not qualified, expected rent will be considered as gross annual value. First test. House property is let out? Yes, it was let out for 6 months. Condition 1 satisfied. House property vacant? Yes, house property vacant for 6 months. Condition 2 also satisfied. If there is no vacancy, then what will be the scenario? If there is no vacancy, then actual rent minus unrealized rent. 50,000. If vacancy is not there, then for 12 months house property will be let out, right? So 50,000 into 12 months minus unrealized rent 54,000. How much it will be? 6 lakhs minus 54,000. It will be 5,46,000. If there is no vacancy, then let us compare actual rent minus unrealized rent with expected rent. Actual rent minus unrealized rent is 5,46,000. Expected rent is how much is expected rent? 5,04,000. Now what is the equation here? In this, actual rent minus unrealized rent is greater than expected rent. That means if there is no vacancy, actual rent minus unrealized rent is greater than expected rent. Condition 3 also satisfied. As all the 3 conditions are satisfied, the reason for actual rent less than expected rent is vacancy. Vacancy test qualified. Now in this case, actual rent minus unrealized rent 2,46,000 will be considered as gross annual value. Now house 4. Fair rent or municipal rent, whichever is higher means 6 lakhs. So step 1 result is 6 lakhs. Step 2, result of step 1 or standard rent 2 lakhs. Whichever is lower means 2 lakhs. So how much is expected rent? Expected rent is 2 lakhs. Actual rent 15,000 rupees. It was let out for 7 months and vacant for 5 months. Now let us calculate actual rent minus unrealized rent for house property 4. Actual rent minus unrealized rent. How much is actual rent? 15,000. It was given on rent for 7 months. How much is unrealized rent? Unrealized rent is 0. So 15 sevens are, I think, 90,000, 1,05,000. Now let us compare actual rent minus unrealized rent with expected rent. Actual rent minus unrealized rent 1,05,000. Expected rent 2 lakhs. Actual rent minus unrealized rent is less than expected rent. So now we have to do vacancy test. 3 conditions. Condition 1, it was let out for 7 months. Condition 1 satisfied. Second 2, it was vacant for 5 months. Condition 2 satisfied. Condition 3, no vacancy. If there is no vacancy, then how much will be actual rent minus unrealized rent? 15,000 into 12 months minus 0, 1,80,000. If there is no vacancy, then let us compare actual rent minus unrealized rent with expected rent. Actual rent minus unrealized rent 1,80,000, expected rent 2 lakhs. See carefully, even if there is no vacancy, still in this case, actual rent minus unrealized rent is less than expected rent. That means whether condition 3 satisfied. As per condition 3, if there is no vacancy, then actual rent should be greater than or equal to expected rent. But here, if there is no vacancy, actual rent is less than expected rent. So condition 3 not satisfied. If condition 3 is not satisfied, then vacancy test failed. 23(1)(c) not applicable. Reason is not vacancy. If reason is not vacancy, then expected rent will be considered as gross annual value. Gross annual value is equal to expected rent is equal to 2 lakhs. So 2 lakhs will be considered as gross annual value. So for house property 4, what is the gross annual value? Gross annual value is 2 lakhs. Next, let us see for house property 5. Fair rent or municipal rent, whichever is higher, 6 lakhs or 4 lakhs, whichever is higher means 6 lakhs. Step 2, result of step 1 or standard rent, whichever is lower. Here standard rent is not given, right? So result of step 1 will be considered as result of step 2. So step 2 is 6 lakhs. Now, house property is given on rent for 60,000 rupees. It is occupied for 10 months. And unrealized rent is 90,000 and it is vacant for 2 months. First of all, expected rent is 6 lakhs. Now let us see house property 5. Expected rent 6 lakhs. Actual rent minus unrealized rent. How much? 60,000 into 10 months minus how much is unrealized rent? 90,000. 6 lakh minus 90,000, 5 lakh 10,000. So actual rent minus unrealized rent, let us compare with expected rent. 5 lakh 10,000, 6 lakhs. Obviously 5 lakh 10,000 is less than 6 lakhs. Actual rent minus unrealized rent is less than expected rent. We have to do vacancy test. Condition 1, house property is vacant for 2 months. Satisfied. Condition 2, house property was let out for 10 months. Condition satisfied. Condition 3, no vacancy. If vacancy is not there, then how much will be actual rent? 60,000 into 12 months, 7,80,000. Correct? Sorry, 7,20,000. Unrealized rent 90,000. So how much will be actual rent minus unrealized rent? 7,20,000 minus 90,000, 6,30,000. So let us compare actual rent minus unrealized rent with expected rent. 6,30,000. Expected rent 6 lakh. In this case, actual rent minus unrealized rent is greater than expected rent. That means what? Condition 3 satisfied. If there is no vacancy, actual rent minus unrealized rent would be greater than expected rent. If all these 3 conditions are satisfied, then the reason is vacancy. If reason is vacancy, actual rent minus unrealized rent 5,10,000 will be considered as gross annual value. So for house property 5, gross annual value is equal to 5,10,000. Next, house property 6. Fair rent or municipal rent, whichever is higher. Step 1 is equal to 3 lakhs. Step 2, as standard rent is not given, result of step 1 will be considered as step 2. So expected rent 3 lakhs. Step 3, house property rent is 25,000. It was given on rent for 9 months. Now let us discuss. House property 6, right? Actual rent minus unrealized rent. How much is actual rent? 25,000 into how many months let out? 9 months let out. 25,000 into 9 months minus how much is unrealized rent? Unrealized rent is 0. 25,000 into 9. How much? 2,25,000. 2,25,000 minus 0. 2,25,000. Expected rent is 3 lakhs. Let us compare actual rent minus unrealized rent with expected rent. 2.25 lakhs, 3 lakhs. Actual rent minus unrealized rent is less than expected rent. Again, let us check 3 conditions. Condition 1, it was let out for how many months? Let out for 10 months, right? Sorry, 9 months. 9 months. Condition 1 satisfied. Condition 2, vacant for 3 months. Condition 2 satisfied. Condition 3, no vacancy. If there is no vacancy, then actual rent will be 25,000 into 12, 3 lakhs. So if there is no vacancy, actual rent minus unrealized rent is 3 lakhs. Expected rent is also 3 lakhs. Here it is exactly equal to 3 lakhs. If there is no vacancy, actual rent minus unrealized rent is exactly equal to 3 lakhs. In this case also, condition 3 satisfied. As 3 conditions are satisfied, original actual rent minus unrealized rent 2,25,000 will be considered as gross annual value. See, whatever the gross annual value calculation that we have seen now, you can apply to any question, you will get the answer, the same format. Okay. Note points. If standard rent is not given, I have already told you result of step 1 will be considered as result of step 2. Next, if house property was purchased or constructed or construction was completed during the current previous year, then gross annual value should be calculated only for the period for which house property is in existence. What do you mean by this? Let's say year consists of 12 months, 1st April to 31st March. Completion certificate received on 1st June 2024. In this case, gross annual value should not be calculated for 12 months, but gross annual value should be calculated from 1st June 2024 to 31st March 2025. Why, sir? House property is not in usage for 12 months. In this case, house property is in usage only from 1st June. So June to March. That means only for 10 months we are going to calculate gross annual value. Very important in examination. Even if small mistake is done, gross annual value will go wrong. So be careful. See for how much period house property is in existence. Only for that period calculate the gross annual value. So our discussion with regard to gross annual value is completed. Now let us discuss about municipal taxes. Municipal taxes are allowed as deduction only if 2 conditions are satisfied. First condition, they are allowed as deduction on cash basis. Only when you pay municipal taxes, then only you can claim as deduction. On accrual basis, you cannot claim municipal taxes as deduction. Second condition, municipal taxes should be paid by the owner. That means what? If tenant pays municipal taxes, those municipal taxes owner cannot claim as deduction. Only if owner pays municipal taxes, that too during current previous year, if owner pays municipal taxes, then only municipal taxes are allowed as deduction from gross annual value. Another important point, last year municipal taxes paid in current previous year, in current previous year only they are allowed as deduction. Next year municipal taxes paid in current previous year, even next year municipal taxes, advance municipal taxes are also allowed as deduction in current previous year because they are paid in current previous year. So very simple, whether municipal taxes are belonging to earlier years or future years or current previous year, that is not at all relevant. What is relevant is how much municipal taxes are paid in current previous year. Only those municipal taxes will be allowed as deduction. Municipal taxes are not deductible for self-occupied property or unoccupied property. I already told you, in case of self-occupied property, gross annual value is 0, net annual value is also 0. That's why municipal taxes are not allowed for self-occupied property. In case of resident and ordinary resident, all incomes are taxable. That means income from foreign house property is also taxable. Whenever you are calculating income from foreign house property, then whatever the municipal taxes that are paid to foreign government are there, even those municipal taxes are also allowed as deduction. In case of RNOR and non-resident, if foreign house property income is received in India, then it becomes Indian income and it is taxable. Then also, whatever the municipal taxes that are paid outside India to foreign government are there, they can be reduced from gross annual value while calculating income from foreign house property. The gross annual value discussion is also over. Municipal taxes discussion is over. Now let us see deductions under section 24. There are two deductions. How many? Two. One is standard deduction under section 24A. Second one is interest on borrowed capital. See, standard deduction is allowed as deduction in place of actual expenses. See, for building also expenses will be there, right? For house property also expenses will be there. Repairs and maintenance will be there. Okay, painting expenses will be there. Collection charges. I have house property in Hyderabad. I gave that house property on rent. Now for collecting the rent, every month I have to go to Hyderabad and collect the rent. So for collection expenses are there, right? Those are called as collection charges. Why I paid collection expenses with regard to rental income only, right? So whatever the expenses relating to house property are there, actual expenses are not allowed as deduction. Always remember, in examination he will give actual repairs and maintenance, fire insurance, just to deviate you. Don't consider actual expenses. Actual expenses are not allowed while calculating income from house property. Only standard deduction is allowed in place of actual expenses, and that standard deduction is also allowed at the rate of 30% of net annual value. So 30% of NAV is allowed as deduction. Sir, in current previous year, no repairs are there. Still standard deduction is allowed. Sir, in current previous year, tenant only paid repair expenses. Even though tenant paid repairs expenses, still owner can claim standard deduction at the rate of 30% of net annual value. Very simply, when you are calculating income from let out property, blindly claim standard deduction at the rate of 30% of net annual value. Okay. Next. 24B, interest on borrowed capital. Sir, what do you mean by this? See, you wanted to have a house property. Now, either for purchase of house property or for construction of house property or for repairs of house property or renovation of house property or reconstruction of house property. For these any purposes, if you take any loan, on that loan you are required to pay interest, right? Who will give free money? Whenever you take loan either for purchase or construction, repairs or renovation or reconstruction, on that loan you are required to pay interest. Whatever the interest that is paid is there, that interest expenditure is allowed as deduction under section 24B. Are you able to understand? Interest expense is allowed as deduction under section 24B. Interest expenditure is allowed as deduction on accrual basis. I have taken bank loan, house property loan from bank, but in current previous year I did not pay interest. Even though I do not pay interest, still that interest I can claim as expenditure while calculating income from house property. Why? Because interest expenditure is allowed as deduction on accrual basis. Next. Interest under section 24B is equal to pre-construction period interest. In shortcut, we call this as PCPI plus current year interest. Sir, what do you mean by pre-construction period interest? Wait, I will discuss in a little while. Now let us discuss significant points. Or if a fresh loan has been raised to repay the original loan, then interest payable in respect of second loan would be admissible. What do you mean by this? Like from SBI, I took housing loan. Housing loan is 80 lakhs. Rate of interest is 12%. ICICI came to me. It said, sir, why you are paying 12% interest? In our ICICI bank, we are only charging 9% interest rate. Is it better to pay 12% or 9%? 9%, right? So I took 80 lakhs loan from ICICI bank. I repaid SBI loan. From today onwards, I am paying interest to ICICI bank at the rate of 9%. That means what? I have taken second loan, repaid the first loan, and now onwards I am paying interest on second loan. Now interest on second loan, that is allowed as reduction under section 24B. So if a second loan is taken for repaying first loan, interest on second loan is allowed as reduction under section 24B. Interest on interest. You know penalty, right? 80 lakhs loan, 9% interest. So how much interest I have to pay? 80 lakhs into 9%, 7.2 lakhs interest I have to pay. But what happened? I paid interest lately for 1 month. He charged again interest 10%. That means penalty. How much is penalty? 7.2 lakhs into 10%, 72,000. Now this penalty is also called as interest on interest. This penalty is not allowed as deduction under section 24B. So whatever the penal interest is there, interest on interest, that is not allowed as deduction under section 24B. This deduction is subject to section 25. Whenever you are borrowing housing loan from non-resident outside India or any person outside India, you have to pay interest to that person outside India, right? Before paying that interest, you are required to deduct TDS. Only if you deduct TDS, then only interest is allowed as expenditure, allowed as deduction under section 24B. If you do not pay interest, interest is not allowed as deduction under section 24B. Is it clear? No deduction is allowed for any brokerage or commission for arranging the loan. See, there is a broker. Through broker, you got the housing loan. Broker is asking for 1% commission. You paid 1% commission to the broker. That is also expenditure. But that 1% commission, that expenditure is not allowed as deduction under section 24B. Interest include commitment charges. Commitment charges means what? Loan processing charges. Bank will come and verify the area of our house property, area of our land. There will be registration charges, documentation charges. So whatever the commitment charges that is charged by bank is there, that is allowed as expenditure under section 24B. No restriction on lenders. That means what? I want to purchase, I want to construct one building. I took loan from 5 banks. For 5 banks, I am paying interest. All these 5 banks interest is allowed as deduction under section 24B. Are you able to understand? There is no restriction. From how many you have taken the loan? That is no point at all. You can take loan from n number of persons. For n number of persons, whatever the interest paid, that is allowed as deduction under section 24B. Unpaid purchase price would be considered as capital borrowed. What do you mean by this? I took loan 1 crore rupees. I made a down payment of 10 lakhs. Balance 90 lakhs I will pay in 20 years. So 90 lakhs is unpaid purchase price which I will repay over 20 years. Whatever the unpaid purchase price 90 lakhs is there, that is considered as loan amount, and on that loan amount whatever the interest is there, that is allowed as deduction under section 24B. So whatever the unpaid purchase price, that is considered as capital borrowed, or that is considered as loan. Principal repayment of loan. See, EMI, you know, right? Equated monthly installment. EMI consists of principal component as well as interest component. Principal component is eligible for deduction under section 80C only under optional tax rates. Interest component is allowed as deduction under section 24B. And additionally also under chapter 6A deductions, these two under optional tax rates. Over and above interest under section 24B, extra interest also you can claim as deduction under section 80EE and 80EEA. Now let us see what pre-construction period interest means. Yes, now let us discuss Pre-construction period interest. I took a loan of 3 lakhs on 1st April 2022 for construction of house property. House property construction completed on 1st July 2024. Now, rate of interest is 9%. Interest is to be calculated, right? 1st April 22 for 22-23, 23-24, 24-25. When house property construction is completed, house property construction is completed on 1st July 2024, correct? Now, listen carefully. From 1st April onwards up to 31st March preceding the date of completion of construction. What is date of completion of construction? 1st July 2024. Before 1st July 2024, what is the 31st March? 31st March is 31st March 2024. Whatever this period is there, that period we call as pre-construction period. From date of borrowing up to 31st March preceding the date of completion of construction. From date of borrowing up to 31st March preceding the date of construction completion. Whatever the period is there, that period we call as pre-construction period. During this pre-construction period, whatever the interest is there, that interest we call as pre-construction period interest. How much is pre-construction period interest? How much is the loan that I have borrowed? 3 lakhs. 3 lakhs into 9%. How much? 27,000. For 23-24, 27,000. So how much is pre-construction period interest? 54,000. Please remember, pre-construction period interest is not allowed as deduction during pre-construction period. Sir, why sir? You are only saying pre-construction period. During pre-construction period, whether house property is in existence? No. If house property is not in existence, will you calculate income from house property? You will not calculate income from house property. If you do not calculate income from house property, how can you claim interest as expenditure? You cannot claim. That's why pre-construction period interest not allowed as deduction during pre-construction period. Is it clear? Sir, then how pre-construction period interest is allowed as deduction? The year in which house property came into existence. When it came into existence? It came into existence in 24-25, right? From 24-25, pre-construction period interest is allowed as deduction. But total pre-construction period interest is not allowed as deduction in the year in which house property comes into existence. This will be allowed as deduction over a period of 5 years in equal installments. That means what? 54,000 into 1 by 5. How much? 10,800. Every year 10,800 will be allowed as deduction for a period of 5 years starting from the year in which house property came into existence. When house property came into existence, it came into existence on 1st July 2024, that means 24-25. So from 24-25 onwards, over a period of 5 years, pre-construction period interest will be allowed as deduction. So 24-25, 10,800, 25-26, 10,800, 26-27, 10,800, 27-28, 10,800, 28-29, 10,800. Over a period of 5 years, pre-construction period of interest will be allowed as deduction. For 29-30, whether pre-construction period interest is allowed as deduction? No, it is not allowed as deduction because already 5 years over. It is allowed as deduction only for 5 years in equal installments. In 24-25 also there will be interest, right, if it is not paid. So whatever interest for current year is there, that we call as current year interest. This is pre-construction period interest. So how much is current year interest? Like 3 lakh into 9%, 27,000. So how much is total interest? 10,800 plus 27,000, 37,800. So this we call as total interest. This total interest is allowed as deduction under section 24B. So deduction allowed under section 24B is equal to pre-construction interest plus current year interest. Current year interest means for current previous year whatever the interest is there, that we call as current year interest. To that we will also add 1/5 of the pre-construction period interest. Here many students will think in a wrong way. From date of borrowing up to date of construction completion, they will calculate pre-construction period interest, but that is not correct, that is wrong. You always have to calculate pre-construction period interest from date of borrowing up to 31st March. Very important, date of borrowing to 31st March. That means, simple thing to remember, pre-construction period interest is always calculated up to 31st March. So every time you will calculate pre-construction period interest for 31st March only. With 31st March you have to take that 31st March preceding date of construction completion. Are you able to understand? Now some students will ask me a doubt. Sir, before completion of construction, if housing loan is completely repaid, then how to calculate pre-construction period interest? That means what? In this case, you have taken loan, right? Entire loan was repaid on 31st December 2023. When construction completed 1st July 24, but entire loan was repaid on 31st December 23. Then from date of borrowing up to date of repayment, whatever the interest is there, this interest will be considered as pre-construction period interest. Are you able to understand? For 20 to 23 it will be 27,000. For 20, I mean up to 31st December 23, how much? 3 lakh into 9% into 9 by 12. 20,250. That will be considered as pre-construction period interest. If housing loan is repaid before completion of construction, from date of borrowing up to date of repayment, whatever the interest is there, that will be considered as pre-construction period interest. Now, many students will get doubt. Sir, is there any limit? Can we claim total interest as deduction, or is there any limit? That I am going to answer through this chart. For let out property, deemed to be let out property, there is no limit. Whatever the interest amount, you took 10 crores loan, interest amount is 80 lakhs, total 80 lakhs you can claim as deduction. For let out property and deemed to be let out property, 100% of the interest will be allowed as deduction. Sir, what do you mean by deemed to be let out property? I will explain, wait. For self-occupied property or unoccupied property, if assessee is paying taxes under default tax rates, interest under section 24B is not at all allowed. Are you able to understand? So, is there any quantum limit for deduction under section 24B? Yes. For let out property, there is no quantum limit. Entire interest you can claim as deduction. For self-occupied property under default tax rates, interest under section 24B is not allowed. Under optional tax regime, either 2 lakhs or 30,000 is allowed as deduction. What do you mean by this, sir? For self-occupied property, if loan is taken for purchase or construction, then 2 lakhs or 30,000 is allowed as deduction. If loan is taken for repairs, renewal, reconstruction, then maximum 30,000 is allowed as deduction. My dear friends, please remember, let out property, no limit, 100% interest allowed as deduction. Self-occupied property under default tax rates, no interest allowed under section 24B. Optional tax rates, if loan is taken for purchase or construction, either 2 lakhs or 30,000 is allowed as deduction. If loan is taken for repairs, renewal or reconstruction, only 30,000 is allowed as deduction. Sir, you have told if loan is taken for purchase or construction, then 2 lakhs or 30,000 is allowed as deduction. when 2 lakhs is allowed, when 30,000 is allowed. If all these three conditions are satisfied, then 2 lakhs is allowed as deduction. Conjunction and. If any one of the conditions not satisfied, then only 30,000 is allowed as deduction. Are you able to understand? What are three conditions? Loan must be taken on or after 1st April 1999, and construction or purchase should be completed within 5 years. These 5 years you should not calculate from date of taking loan, but you have to calculate from end of the financial year in which loan is taken. I will explain. So loan should be taken on or after 1st April 1999. Construction should be completed within 5 years. If you are taking loan from bank or any financial institution or any lender, you have to obtain interest certificate. Loan was taken only for the purpose of house property. If these three conditions are satisfied, then 2 lakh rupees is allowed as deduction. If loan is taken before 1st April 99, or if loan is taken for repairs renewal, or if interest certificate is not obtained, then 2 lakhs is not allowed as deduction. Only 30,000 is allowed as deduction. Are you able to understand? So maximum deduction allowed is 2 lakh rupees. That too only if three conditions are satisfied. Loan should be taken for on or after 1st April 1999, and that loan should be for purchase or construction. Construction should be completed within 5 years. Interest certificate should be taken. If all these conditions are satisfied, 2 lakhs is allowed. Otherwise only 30,000 is allowed as deduction. Next. As per Income Tax Act 1961, any individual can own maximum 2 self-occupied properties. If more than 2 self-occupied properties are owned, then remaining self-occupied properties, even though they are self-occupied, they are deemed as let out properties. Let's say I have 5 houses. Out of 5 houses, I can choose only 2 houses as self-occupied properties. Remaining 3, even though physically they are self-occupied, in the eyes of Income Tax Act, they are considered as deemed to be let out properties. Now, why I am saying this? Whatever 2 lakhs or 30,000 limit is there, this is applicable for 2 self-occupied properties together. That means what? 2 lakh interest or 30,000 interest. This is not for single self-occupied property. For 2 self-occupied properties together, maximum interest allowed under section 24B is 2 lakh rupees or 30,000 rupees under optional tax regime. If all conditions are satisfied, for 2 self-occupied properties together, 2 lakhs will be allowed. If any one of the conditions not satisfied, for up to 30,000 rupees deduction is allowed. Under default tax regime, simple. Interest under section 24B is not allowed as deduction. Next, note points. Loss from house property. In set off of losses, you will get clarity. Whatever the loss from house property is there, that you can set off against income from other heads of income, but maximum set off allowed is only 2 lakhs. And this interhead set of benefit is available only under optional tax rates. If SSE is paying taxes under default tax rates, whatever the loss from house property 2 lakhs is there, that is not eligible for set off against other heads of income. That means interhead set off benefit is not available for loss from house property under default tax rates. Under optional tax rates, loss from house property you can set off against other heads of income, but maximum set off allowed is 2 lakhs. This I already discussed. If house property, more than 2 house properties are self-occupied, at the option of the SSE, any of the 2 house properties are considered as self-occupied properties. Remaining house properties, even though they are self-occupied, they will be considered as deemed to be let out properties. Sir, what do you mean by deemed to be let out? Even though they are self-occupied, they will be assumed as let out properties only. Here, basically they are self-occupied properties, but they are being considered as deemed to be let out property. In case of deemed to be let out property, whether actual rent will be there, actual rent will not be there. That's why in step 3, generally in step 3 what we will do, we will compare actual rent minus unrealized rent with expected rent, correct? But in case of deemed to be let out property, actual rent minus unrealized rent will not be there. That's why whatever the expected rent is there, that itself will be considered as gross annual value. So always remember, for deemed to be let out property, whatever the expected rent is there, expected rent itself will be considered as gross annual value. I told Let's say I am having 5 properties. 2 only I can choose as self-occupied properties. Remaining 3, even though they are self-occupied, they will be considered as deemed to be let out properties. House property 1, 2, 3, 4, 5. For all these are self-occupied properties. But I will assume these 5 house properties as deemed to be let out properties, and I will calculate income from deemed to be let out property 80,000, 90,000, 30,000, 1.2 lakh, 60,000. Now, whichever the house property is having highest income as deemed to be let out property, 1.2 lakh, 90,000. These two I will assume as self-occupied properties. Remaining, even though they are self-occupied, they will be considered as deemed to be let out properties. Sir, can I choose only house property 2 and 4 as self-occupied property for lifetime? No. Next year, if I want to change the combination, I can change the combination. I can choose house property 1 and 3 as self-occupied and remaining as deemed to be let out properties. Are you able to understand? Where house property is let out for part of the year and self-occupied for part of the year. What do you mean by this? Generally, year consists of 12 months, right? From 1st April to 31st December, house property was let out. From 1st January to 31st March, house property was self-occupied. That means in 1 year only, part of the year is let out and part of the year is self-occupied. In this scenario, even though for part of the year it is let out and remaining part of the year it is self-occupied, for the whole year we will consider this house property as deemed to be let out property. So please remember, for a certain period of year, if house property is self-occupied and remaining period it is let out, then for the whole year assume it as deemed to be let out property. But there are two special points here. Special point 1. Only in this case, part of the year self-occupied, part of the year let out. Only in this case, in step 3 calculation of gross annual value. Generally what we will do, we will compare actual rent minus unrealized rent with expected rent. But here don't compare actual rent minus unrealized rent with expected rent. Take whichever is higher, actual rent minus unrealized rent or expected rent, whichever is higher you have to take as gross annual value. Second special point. You know fair rent, right? Step 1, fair rent or municipal rent, whichever is higher. Sometimes in the question, fair rent will not be given. If fair rent is not given in the question, actual rent for whole year will be taken as fair rent. But this special point is applicable only in this case for part of their house property self-occupied, part of their house property let out. Only in this case, if fair rent is not given in the question, actual rent for whole year take as fair rent. For your better understanding, I have given one small example also, you can see. Mr. J, who works with ITC Limited, owns a house in Jaipur which was constructed on 1st March 2024 and has been occupied by him for his residence since then. He took loan of 9 lakhs on 1st August 2022 at the rate of 8% per annum. So let us plot this. Whenever information is there, you should plot, then you will get better understanding. 1st April 22, how much is loan taken? I am sorry, loan was taken on 1st August 22. How much is the loan? 9 lakhs, rate of interest 8%. When construction completed? Construction completed on 1st March 2024. On 1st March 2024, construction completed. Good. What is current previous year? Current previous year is 24-25. Correct. Now, The entire loan is still outstanding. Municipal taxes and land revenue of the Jaipur house are unpaid. That means municipal taxes are not paid. If municipal taxes are not paid, they are not allowed as deduction in current previous year. In the year in which they are again paid, in that year they are allowed as deduction. Now, first we need to, in order to calculate interest for 24-25, we need to calculate pre-construction period interest. What is pre-construction period? From date of taking loan up to 31st March preceding the date of completion of construction. What is date of completion of construction? 1st March 2024. Okay. For 1st March 2024, before that what is 31st March? Before that 31st March is 31st March 2023. For this period, whatever the interest is there, that interest we call as pre-construction period interest, correct? That means effectively in 23-24 house property came into existence. So 23-24 interest, current year interest. Before 23-24 whatever the interest is there, that interest we call as pre-construction period interest from date of taking loan up to 31st March preceding the date of completion of construction. Before 1st March 24, what is 31st March? 31st March 23. So how much? 9 lakhs into 8% into 1st August. August, September, October, November, December, January, February, March. That means 8 by 12. How much? 48,000 is pre-construction period interest. Whether total pre-construction period interest is allowed as deduction? No, only 1/5. How much? 48,000 into 1 by 5. 9,600 will be considered as pre-construction period interest. For 24-25, how much is current year interest? 9 lakh into 8%. How much? 72,000. So current year interest 72,000, pre-construction period interest 9,600. Total how much? 81,600 is interest under section 24B. Correct? Now are you able to understand? Now, Jai was transferred to Mumbai on 1st December 2024, where he resides in a house at a monthly rent of 40,000, and his house at Jaipur was let out on the same day on a rent of 20,000 per month. So he has a house in Jaipur, right? 24-25 Jaipur house. 1st April 24 to 31st March 25. For how many months it is self-occupied? Up to 1st December. From 1st December onwards, it is given on a rent for 20,000 per month. That means what? From 1st April to 1st December, house property was self-occupied. From 1st December to 31st March, house property was let out at the rate of 20,000 per month. That means part of the year self-occupied, part of the year let out. We will consider this house property as deemed to be let out property for the whole year. Are you able to understand? So when house property is considered as deemed to be let out property for the whole year, in gross annual value calculation, step 3 is equal to actual rent or expected rent, whichever is higher. Don't do comparison. Now, information was given, municipal value is given, municipal taxes are given, but municipal taxes are not allowed. Why? Because they are unpaid, they are not paid. Expenses on repair, C, actual expenses, they should not be claimed as deduction. Standard deduction is allowed in place of actual expenses. Fire insurance premium not allowed. Ground rent not allowed. Land revenue not allowed. Interest on loan 72,000. We already calculated, right? 72,000. Clearly observe in this question whether fair rent was given. Fair rent is not given. But this is the case of part of the year self-occupied, part of the year let out. So for whole year we have to consider it as deemed to be let out property. Are you able to understand? So for whole year if we consider it as deemed to be let out property, then fair rent is equal to actual rent for whole year. How much is actual rent? 20,000, right? 20,000 into 12 months. Fair rent is equal to 2,40,000. Now shall we calculate gross annual value? Calculation of gross annual value. Step 1, fair rent or municipal rent, whichever is higher. How much is fair rent? 2,40,000. How much is municipal rent? Given 1,80,000. Whichever is higher means 2,40,000. Standard rent not given. If standard rent is not given, result of step 1 is equal to result of step 2. So expected rent is equal to 2,40,000. How much is actual rent? It is given on rent from 1st December onwards. So December, January, February, March, 4 months. 20,000 into 4, 80,000. In step 3, what we will do? We will compare. But in this case, you should not compare because this is a special case. In this case, gross annual value is equal to actual rent minus unrealized rent or expected rent, whichever is higher. Actual rent minus unrealized rent 80,000. Expected rent 2,40,000. Whichever is higher means 2,40,000. Gross annual value is equal to 2,40,000. From this municipal taxes, whether municipal taxes are allowed? No. Why? Because they are unpaid. So they are not allowed as deduction. How much is net annual value? 2,40,000. From this standard deduction under section 24A, how much is standard deduction? 30% of net annual value. 2,40,000 into 30%, 72,000. Second, 24B, interest on borrowed capital. How much? We already calculated. 81,600. One more thing here. It is deemed to be let out property, right? For let out property, there is no limit, restriction. Entire interest you can claim as deduction. 81,600. So how much is income then? 2,40,000 minus 72,000 minus 81,600. 86,400 is income from deemed to be let out property. Is it clear? Good. Next, in case of house property, portion let out and a portion self-occupied. What do you mean by this? I constructed one building. Ground floor, first floor. Ground floor was rented. First floor was used for residential purpose. Clearly observe, this is a single house property. Even though it is a single house property, part of the house property was rented and part of the house property was used for residential purposes, own purposes. So even though it is a single house property, for calculation of income under the house property, it will be considered as two different properties. First floor will be considered as self-occupied property, ground floor will be considered as let out property. That means even though there is a single house property, but if part of the house property is used for self-occupation and part of the house property is used for let out, even though it is a single house property, it will be considered as two different properties only for the purpose of calculation of income from house property. For first floor, we will apply method of calculation of self-occupied property. For ground floor, we will apply method of calculation of let out property. Is it clear? Good. But please be careful. He will give municipal taxes for the whole house. That municipal taxes you have to divide between ground floor and first floor based on the area. If area is not given, half for first floor, half for ground floor. Fair rent, municipal rent, standard rent, these three also will be given for entire house property. Don't get confused. Divide between first floor and ground floor properly. Without dividing, if you start calculating means, then you are going to make a mistake. Ultimately answer will come wrong. Many times ICA is playing with students only with this just small thing. He will give fair rent for whole house property. Students, okay, they are in a urge. They know calculation of gross annual value, fair rent or municipal rent, whichever is higher. Blindly, they will apply the formula. Before applying the steps, please go through the problem and see whether fair rent is for whole house or for that particular property. If it is for whole house, divide it and calculate gross annual value. House property held as stock in trade. What do you mean by this? Let's say there is a real estate company. They constructed one apartments consisting of 10 floors. Completion certificate. This is received on 9th March 2014. 9th March 2014, or let us say this is received on 9th March 2022. Even real estate company has 10 floors. It wanted to sell house property. It wanted to sell flats, but nobody is coming. Government changed. There is a drop in demand of house properties and nobody is purchasing house properties. So real estate company, whatever the floors properties that it has constructed, it can give on rent, right? So if real estate company gives on rent, then obviously it is taxable under the head income from house property and it is taxable as let out property. But house property is idle. It was not given on rent. These house properties, these are idle. Even though they are idle, only 2 years time is given for selling those house properties. Within 2 years, if these house properties are not sold, even though they are idle, they will be considered as deemed to be let out property. That means what? 2 years time. 2 years time, don't calculate from completion certificate. Don't calculate. Calculate from 31st March. So for 9th March 2022, this falls under the previous year 21-22, correct? Now for 21-22, 31st March 2022 is last date. From 31st March 2022, 2 years means 31st March 2024. All house properties remaining 8 floors, they are to be sold on or before 31st March 2024. If they are not sold on or before 31st March 2024, what will happen? From 1st April 2024 onwards, even though they are idle, they will be considered as deemed to be let out properties, and whatever the expected rent is there, that is considered as gross annual value. Let me summarize quickly. Those who are holding house properties as stock in trade, those stock in trade, if they are let out, income is taxable under the head house property. Otherwise, whatever the stock in trade is there, that is to be sold within 2 years from the end of the financial year in which completion certificate is received. Completion certificate received on 9th March 2022. End of financial year 31st March 2022. 2 years means 31st March 24. Within 2 years, stock in trade is to be sold. If stock in trade is not sold, then even though it is idle, still they will be considered as deemed to be let out properties, and expected rent will be considered as gross annual value. Now let us see taxability of recovery of unrealized rent and arrears of rent received. See, whatever the unrealized rent that is subsequently received is there, and whatever the rent belonging to earlier years, if it is received in current previous year, we call it as arrears of rent. These are taxable on cash basis. The year in which arrears of rent is received or the year in which unrealized rent is recovered, it is taxable on cash basis. The year in which they are received, in that year it is taxable. Here important thing is, even though SSC is not the owner during the year of realization, still unrealized rent recovered or arrears of rent received is taxable. 5 years ago, I have a house property. Tenant has to give me 50,000 rupees. But at that time, he did not give. Later on, I sold the house property. In current previous year, voluntarily he came and he gave 50,000 rupees. So in current previous year, there is recovery of unrealized rent belonging to earlier years. In current previous year, 50,000 is taxable. But total 50,000 is not taxable. 30% standard deduction is allowed. 50,000 minus 30%, 15,000. That means only balance 35,000 is only taxable. So arrears of rent received or recovery of unrealized rent, it is taxable in the year of realization on cash basis. Total unrealized rent received or arrears of rent received is not taxable. 30% deduction is allowed and balance 70% is taxable. In the year of realization, even the assessee is not the owner. Now this 35,000 in current previous year, I am not the owner of that house property. Still 35,000 is taxable to me. Are you able to understand? Composite rent. Sir, what do you mean by composite rent? Sometimes along with rent for house property, rent for assets as well as rent for services will also be charged. That rent we call as composite rent. I wanted to take an apartment on rent in Hyderabad. Owner told rent is 50,000 rupees. In that 50,000 rupees, he will give me 3 BHK flat. Furniture is also provided. TV, AC, washing machine. Okay, furniture provided. Along with that, lift service, security service, housekeeping facility. Okay, 24/7 electricity. All these facilities are also given at the rate of 50,000 per month. Now I am paying 50,000 rupees. In this 50,000 rupees, he is giving me house property on rent, he is giving me assets on rent, and he is also providing various services. Now for all these three together, I am paying 50,000 rupees. This 50,000 we call as composite rent. Are you able to understand? So if lump sum rent is received for renting of building as well as assets as well as for services, then that lump sum rent we call as composite rent. In that composite rent, whatever the charges for different services are there, they are obviously taxable under PGBP or IFOS. So for owner, whatever the amount that is received for provision of services, that amount is obviously taxable under other sources. Whatever the amount that is received for building and other assets are there, that we have to discuss. If let out of building and other assets are inseparable, what do you mean by this? I went to a hotel. In that hotel, the room rent is 4,000 rupees. In that 4,000 rupees, he is giving me room, he is also giving me assets, he is also providing services, and in total he said 4,000 rupees. Now, I wanted to take only room. I don't want assets. I don't want services. Only room I want. Whether hotel person give, he will not give. That means what? Owner is ready to give house property only if along with house property other assets are also taken on rent. This is one version. Second version, owner is ready to give only room, or if customer wants, owner is ready to give room along with assets. But customers, when they are coming to hotel, they expect both assets and room. That means what? Customers are not ready to take room on rent unless assets are provided. That means what? From customer point of view, customer is ready to accept the house property only if along with house property other assets are also given. Then in this situation, whatever the rent that is received, that rent we call as composite rent inseparable. Are you able to understand? That means either from owner point of view or from customer point of view, they are willing to give house property on rent, or customer is willing to take house property on rent only if along with house property other assets are also given. In this situation, whatever the rent that is received is there, that rent we call as composite rent. So best example is hotels. In hotels, hotel owner is not willing to give house property alone, even customer also not willing to take house property alone. Both will enter into agreement only if along with house property other assets are also given. That's why in hotel business, whatever the rent that is received is there, that is taxable under the head PGBP or IFOS. Are you able to understand? So when can we tell composite rent is inseparable? If letting out of house property is not possible without letting off assets. That means what? House property letting is possible only if along with house property other assets are also given. Then only owner will be ready to give or customer is ready to take. In this situation, whatever the composite rent that is received is there, that we call as inseparable, composite rent inseparable. Another critical point. I went to hotel. He said, sir, for room 3000 rupees, sir, for assets 1000 rupees, sir. That means he is bifurcating. Even though he bifurcates, still total 4000 is taxable to the hotel under the head PGBP or IFOS, because composite rent is inseparable. Once composite rent is inseparable, even though separate amount is charged for house property and separate amount is charged for other assets, total amount is taxable to the owner under the head PGBP or IFOS. You can see this is applicable even if sum receivable for two lettings is fixed separately. Even though separate rent is charged, still whatever the total rent is there, that is taxable under PGBP or IFOS. If let out of building and other assets are separable. What do you mean by separable? In my area, I wanted to take another flat for video recording purpose. I went to that flat. Owner told, sir, if you want only flat, 15,000 rupees, sir. If you also want assets, 20,000 rupees, sir. So there are 10 flats. Owner is willing to give either only flat or flat with assets. Some of the customers also, they took only flat on rent. Some of the customers took flat plus assets on rent. That means in this scenario, the owner is willing to offer both separately. Customer is also willing to take both separately. In this situation, whatever the rent 15,000 received for house property is there, that is taxable under the head income from house property, and whatever the rent 5,000 for other assets is there, that is taxable under PGBP or IFOS. Are you able to understand? So little bit, if you listen carefully, you will understand. Please listen very carefully this concept. If you do not understand at one go, listen it once again. Next. Income from co-owned property. What do you mean by co-owned property? If a house property is owned by more than one owner, then we can say that house property is under co-ownership. Let's say house property is there. For construction of this house property, 50% amount was spent by A, 50% amount was spent by B. Then A and B together we call as co-owners. Listen carefully. The share, whatever is there, that should be ascertainable. Then only we can call the house property is under co-ownership. If share is not ascertainable, then we cannot say it is under co-ownership. Is it clear? So, if a house property is owned by two or more persons and share of each person is determinable, then we can say that house property is under co-ownership. Next. House property under co-ownership was let out. Let's say this was let out. Whenever house property under co-ownership is let out, then listen carefully. Even though it is owned by two persons, deem it as the house property is owned by single person, single owner. Let's say gross annual value is 1 lakh. Municipal taxes paid are 10,000. Net annual value 90,000. Standard deduction 30%, 27,000. Let's say interest on borrowed capital was not there. How much is income from let out property? 90,000 minus 27,000, 63,000. If a house property under co-ownership is let out, for the purpose of calculation of income from house property, assume it as owned by single owner and calculate total income from let out property. Once you calculate income from let out property, divide it among co-owners as per their co-ownership ratio. What is co-ownership ratio? 50-50. So 63,000 divided by 2 means 31,500, 31,500. My dear friends, please don't calculate separately for co-owners. No, don't do like that. Assume it as owned by single owner. Calculate total income from let out property. Once you arrive at income from let out property, divide it among co-owners as per their co-ownership ratio. Is it clear? This is the methodology you have to adopt while you are calculating income from let out property under co-ownership. Now, income from let out property, sorry, income from self-occupied property under co-ownership. You all know, in case of self-occupied property, maximum interest allowed for two self-occupied properties together is 2 lakhs or 30,000. So if a house property is under co-ownership, let's say house property is owned by A and B. A share is 60%, B share is 40%. This consists of two floors, ground floor and first floor. First floor is occupied by A, ground floor is occupied by B. That means it's totally whatever the co-owned house property is there, it is self-occupied. In this scenario, income from self-occupied property is calculated separately for A and calculated separately for B. Are you able to understand? Now, A has another house property which is self-occupied. That means what? Individually, A has one self-occupied property. Under co-ownership also, he is having another self-occupied property. That means one self-occupied property separately A has. Under co-ownership, A has second self-occupied property. Now, these two self-occupied properties together, maximum deduction allowed under section 24B is 2 lakhs or 30,000. Is it clear? So, independent self-occupied property plus co-owned self-occupied property. These two together also maximum deduction allowed is 2 lakhs or 30,000. B also individually he can claim 2 lakhs or 30,000 as deduction. Let us solve one problem for better understanding. Miss Aparna co-owns a residential house property in Calcutta along with her sister Dimple, where her sister's family resides. That means what? It's a self-occupied property. So there are two persons, Aparna and Dimple. They both purchased one house and that house is self-occupied property in Calcutta. Both of them have equal share in the property and the same is used by them for self-occupation. Now, Aparna share 50%, Dimple share 50%. Interest is payable in respect of loan at the rate of 50 lakhs at the rate of 10% on 1st April 23 for acquisition of such property. In addition, Aparna owns a flat in Pune. That means what? Now we are discussing about Kolkata house property, right? This is under co-ownership. Do you agree? What is the interest? How much loan was taken? 50 lakhs, 10%. 50 lakhs into 10%, it is 2.5 lakhs. Out of 2.5 lakh, sorry, 50 lakhs into 10%, 5 lakh. Out of 5 lakh, 2.5 lakh being 50% is the share of Aparna and 2.5 lakh is the share of Dimple. Correct? Individually, Aparna maximum interest she can claim as deduction is 2 lakhs. Even Dimple also maximum interest that she can claim is 2 lakh rupees, because for self-occupied property under optional tax rates maximum deduction allowed is 2 lakhs. Even the 2.5 lakhs interest is there, maximum deduction allowed for Aparna is 2 lakhs and for Dimple is 2 lakhs. See, this is co-owned. Apart from this, Aparna is also having one house property in Pune. Even that is also self-occupied property. Now what is interest for that self-occupied property? She took loan of 3 lakh rupees at the rate of 12% per annum on 1st October 23 for repairs. For repairs, maximum deduction allowed under optional tax rates is 30,000 rupees. So let us calculate interest. It's not 1st October 2024, not 23. 3 lakhs into 12% divided by, I'm sorry, it's 23 only. For 24-25 we have to calculate interest for whole year. 3 lakhs into, what is the rate of interest? 12%. 12%, 36,000. Even though 36,000, maximum deduction allowed is only 30,000. See, under co-owned property she has 2 lakhs interest. Individually she has 30,000 interest. Overall 2 lakh 30,000. But for two properties together, can she claim 2 lakh 30,000 as deduction? Maximum deduction allowed is equal to 2 lakhs. So that's what for individual self-occupied property interest and co-owned self-occupied property interest, these two self-occupied properties interest together again cannot exceed 2 lakh or 30,000. So almost more detailed explanation was given with regard to income from house property. Revise it as many times as possible. I wish you all the very best. Thank you.